Today, we will talk about some macroeconomics and how it relates to crypto and where I think that we are actually heading. And I have come across a chart that I think completely explains why the entire Bit- Bitcoin halving idea about uh, price action is not exactly accurate. And in fact, why it's not even really accurate at all, even though that has trended with the price action over time. And let's explain why that is and what this chart is. So a while back, I came across TechDev 52, and it was actually this one right here, which is from July of 2023. And I'm assuming, has put together a chart that shows the price of Bitcoin against the Chinese 10-year bond DXY and the high yield spread. And the MACD and the moving averages here are very, very important, especially when we are comparing the crossovers to when the crypto market has actually taken off. And it's almost exact each time. The only time that it was not, that it did not predict it in front of that bull run was in October of 2020. And it's not just some account out there. In fact, this tweet got approval from Raoul Pal, who I think that a lot in my audience have heard of. So I found this today where TechDev 52 has actually updated this with some more information. So in this first crossover, we had a 2000x in the price of Bitcoin. In 2012, it was an 80x. In 2016, 20x, and in 2020, it was a 5x. So from here, our returns in terms of x's, according to just this right here, probably wouldn't be that high. And a lot of people out there are predicting that this bull run's height in terms of Bitcoin price will be somewhere between about 70K and 90K. I think it could go higher, and that is all because of the Bitcoin ETF pending approvals, which I will touch on here, and why that might completely make this Bitcoin chart just completely explode up. So what are the actual components of this chart? Well, it is the Chinese 10-year government bond yield. That was ugly. It includes DXY, which compares the relative power of the USD to a handful of other currencies, and this really long name, which turns out to be the Bank of America US High Yield Index Option Adjusted Spread. And it somehow accounts for the M2 supply as well. So that is actually referred to somewhat here. It's a different one, but that is talking about the central bank liquidity, which that also plays into accordance with this original chart from TechDev 52, which I unfortunately just X'd out of. So if we tie this and compare this to the entire Bitcoin halving theory, then we can match it up in terms of when it actually kicked off. So our first one was in November of 2012, which was right around here-ish, which is almost exactly in line with when this chart predicted a crypto bull run. Then we have July of 2016, which would be about here, which was almost exactly correct, although it was probably about a month and a half off here. And our most recent one was in May of 2020, which this chart was actually a little bit behind that. So our next halving event is in April of 2024, which would be about here, which actually was on the updated chart that I accidentally X'd out of. But that is beginning to line up more as well. So in fact, the crypto market right now has begun to take off again, and that is shown on this one, which is actually on a log scale right now. But we are beginning to pull away and take off. A lot of people said that we have technically been in a bull since November of 2022, and that's primarily because it's been pretty much up since that point in time. And I couldn't find a good chart on X, but I happened to find a YouTube video that just happened to show what I was actually trying to find, and that it is the crypto market cap predictions over time tends to line up in this channel before it actually pops out. So that is where these predictions of up to 11 trillion market cap are actually coming from. And this right here is from 2020, which actually predicted this a little early, but that just tried to take into account previous price action. So that is actually probably somewhere over here in 2024 or 2025. But if we look at the price of Bitcoin right now, it has only been up since about, since about December, January of 2022. And especially over the last month or two, we have only closed positive at the end of every week, which is something it's done for 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 weeks in a row now, which has not happened since since 2020. So that should be a pretty positive indication about the correlation expectations for this upcoming bull run as well. Now, there are some other things that I think can drastically increase our expectations of the crypto market cap and go above and beyond that 9 to 9 to 11 trillion range that a lot of people are predicting at this point in time. And that all has to do with the Bitcoin ETFs. Now, I found some interesting things from Chad. I can't say STs. So, Grayscale had to register this post with the SEC. This wouldn't have been approved if the ETF was not already all but complete. So that came from this. Grayscale registers their first retail Bitcoin ETF ad to be published on their site with the SEC. This is the end in that process. Now, we can also tie this into XRP, which has had a lot of quote unquote rumors and fake news around ETFs over the last week or two at this point. And there is a Ripple XRP liquid index fund, which I haven't checked into much, but Chad has. And that is from Charles Schwab, which is a big name. So this also led me to think about what other things are happening in the larger macroeconomic and financial institution space. Well, I found a tweet from Mr. Man XRP that says 5 months in, Fed now is doing what it was planned to do. And it's a pretty dry article, in all honesty, but it is just explaining that Fed now, which is actually essentially the precursor to institutional crypto transactions that follow ISO 222, all of that is actually going according to plan, and it should continue to pick up as ISO 222 continues to be turned on and is adopted more and more. It has had some delays by different countries and organizations and institutions, but it is happening. So that also led me into a topic that I still don't truly understand enough to explain well, but I do have some information on it that I will be explaining more here soon, because I think it is incredibly important. And I even touched on the reverse repo operation in the video I did that tied XLM to BlackRock and USDC, and how it appears that BlackRock is positioning themselves to operate like the U.S. Federal Reserve. But the reverse repo operations today fell over 100 billion. Banks use this to put cash in highly liquid U.S. Treasury notes, which allows them to receive the Fed funds rate of 0.05% APR in overnight loans in exchange for T-bills and do the opposite. Blah, blah, blah. As liquidity is sucked out of the system by the RRP, this leaves banks with less capital with which to meet margin collateral requirements, which means they don't or they are beginning to approach the point where they don't have enough of your cash on hand in order to uh, cover all of their transactions and what that they actually have and operate with. So that has a lot of information here, and I should spend a lot more time on that at a different point in time. But that leads me to think about what crypto assets are actually concentrating on financial institutions in order to improve liquidity by removing the need for the extremely costly Nostro Vostro accounts. And that is none other than Ripple and XRP. Now, that is common talk at this point, but it's also extremely comparable to XLM because although they don't have as much involvement with financial institutions at this point in time, they are still tied in to that. And it comes back to how Ripple has been positioning uh, the on-demand liquidity product that is pretty much XRP as a way for financial institutions to be able to operate more freely with less cash on hand. And that also brings me back into the recent advancements in the partnership between Ripple and Uphold, and how Uphold is planning to provide Ripple and ODL XRP with even more liquidity that can be taken advantage of if we were to have a liquidity crisis.